Good evening, Oak Bloke here, and this is going to be covering my article from this week on Greggs. So Greggs released their 4Q25 update, which doesn't really have an awful lot of financials in it. It's got some revenue numbers, it's got some percentages, so quite a lot of I would say unpicking that you have to do. The bit that everybody's got unexcited about is probably the right way to describe it, is that they've picked up on this year on year, year on year improvement will be contingent, and that we expect we expect our going into 2026, we expect sort of like for like results, which is kind of, I mean, for a start, we do not even know what the 2025 results are. So when people say, "Oh well, Greggs is saying that their results are only going to be as good as their 2025 results." Well, for a start, we don't even know what those are yet. I mean, it's just absolutely, it's a bit like sort of saying, "Oh, I don't like green eggs and ham." Well, have you ever tried it? No. Well, I don't like it though. Oh, how do you know you don't like it? Well, I just don't. I mean, it's just illogical. I mean, if you're a serious investor, you should be looking at this and saying, well, let's weigh up. What does 2026 results only being as good as 2025 actually mean? Um, and I guess there's quite a few sort of pieces that you can pick out of this. That uh, there's a lot of, I think, a lot of positives, and we'll talk about those in this video. And I just think people have got it wrong. So this is one of my picks for 2026. Yeah, the bottom line here, competitive position remains strong, and we continue to take market share. So I've kind of made the point in this article that I guess the first thing to say, well, why did the share price fall? I mean, there's a number of explanations. You could say, oh well, they've warned on profits not increasing, which I'll come to, but is as an interesting concept in itself. We'll talk about that in a second. And the chief reason for it falling in price is that you're seeing there, that the level of shorting has gone through the roof. It's the most shorted FTSE 350 company. I think I'm right in saying it's the most shorted FTSE 350 company at the moment, possibly the second highest. But you can see just the level went very, very quickly upwards. Not really entirely sure why. I think this is January 2026, not the 26th of January, because that's 2 weeks, over 2 weeks in the future. Um, but yeah, since the 1st of January, shorts have shot upwards. But the point I make is, I mean, if you understand anything about shorts is essentially you're borrowing a share from somebody that's bought the share. They might have borrowed it from me for all I know. By the way, if you put a sell, like I want to sell my Greggs for £40 a share, if you actually put like a limited sell, uh, then nobody can short your shares. Just a little tip. Somebody told me that once. I was like, oh yeah. If I was meticulous enough and bothered about and confident enough that my shares weren't going to double in price, and I'd be gutted that Greggs got sold for £40 because I had a limited, a limited sell trigger on it. But joking aside, that is how it works. Anyway, there's nearly £200 million worth of shares, and this is just the disclosed ones. So if somebody has shorted more than I think it's 0.5% of the stock, then they have to disclose that they've shorted more than 0.5%. In other words, if you've shorted 0.49% of the stock, you don't need to tell anybody anything. So that number there, 10.5%, could be 20%. It could be higher. What we know about is that there's nearly 200 million, and that's a lot of shares that somebody is going to have to buy back at some point. So every month that a shorter borrows those shares, it's costing them about 0.8% a month. Plus, when the company that they're shorting has to pay, or not has to, chooses to pay dividends, they have to pay for those dividends because they've borrowed the share. So they've got to compensate the, me in my case. So it costs them to to borrow that share for any long period of time. So I think as time goes on, there could well be some twitchy shorters on this stock. But look, it's not about a short squeeze. I'm just pointing out that there's an awful lot of shorters already there. I don't know exactly what they think they're going to achieve because in order to break even just holding it for a few months, they're going to have to basically Greggs is going to have to drop by another pound for it to break even for them, and Greggs would have to drop by several pounds for them to make a profit. I just don't see that that's going to happen. But let's kind of let me kind of explain why I think that. So, I mean, first of all, this is a chart that I came up with, and this was based upon the 3Q25 results. So it was this article here where I included it, and we'll come on to this in a second. But basically, what I did was mapped out all of the levels of investment, the operating cash flow. Well, you can see all the titles there for yourselves. I mean, obviously, the amount of investment has grown over time, the amount of operating cash flow has grown over time, working capital. As they've grown the business, they've consumed, like if you've got I suppose physically, if you've got more and more shops, then you're going to have more and more cash in the tills of those shops, and you're going to have scenarios where I don't know Tesco's and Iceland owe you money because you've got more and more of your sausage rolls, being sold through those supermarkets, but they perhaps I mean I don't know what the trading terms are, but let's say it's 60-day payment terms, something like that. The more pasties and sausage rolls and everything else that you're selling through the supermarkets, the more that you're going to have to fund that through working capital. So you can sort of see, millions and millions a year are having to be soaked into working capital. No, that's not money down the drain. That's just money that is money coming out of the bank. It's money that's sitting as debtors, as stock. Um, and yeah, so it's money that's owed to the business or is an asset of the business, like a stock item in the business. We could see that cash generation, and bearing in mind these last columns here, this one's a half year, this one's a quarter year, this one's a quarter year, that that we can see that there's growing cash generation from operations, and this result here, comparatively, 150 versus 354. Obviously, there's a slight dip there, and part of that is the cash generation from operations was affected by inflation and affected by tax rises. Okay, so but when you read that the 3Q results were 6.8% higher, if you extrapolate out, you arrive to about a 94 million cash generation. And at the time, I said, well, it feels like it can repeat that in 4Q25 as well. And these were the numbers that I came up with. Now, the true number, the actual number, turned out to be just 2 million higher than my estimate of 2149. As I say, a lot of people have been making a lot about the fact that the guidance has dropped by 5%, dropped by 5%. But what you've got to appreciate is that these forecasts that various brokers, analysts are coming up with uh, are themselves just estimates. I mean, the same way as I've done an estimate, I'm pretty proud of that. That's pretty close. 2 million out on 2.15 billion. I mean, that's 0.1% accuracy. Pretty good. But it's not about being perfect. It's about sort of just having a reasonable, what's the word? Just a reasonable assessment of a share and its prospects. And you're not going to get it right all the time. There's going to be things that happen that blindside you. There's things going to be happening that aren't disclosed until they are disclosed. Um, but if you can get it right 70% of the time, you're going to win. Yeah. So right, 30% of the time you lose, but you try and lose little and win lots. Dig into back your winners and cut your weeds, water your flowers. Yeah. So what we probably are going to see, if I'm right about, well, I was pretty much spot on with the revenue. The cost of sale, I've grown, basically said, the margins that they managed to achieve in the first half of 2025, I reckon that they're going to achieve at least those. You can sort of see the cost of sale there was 396. It grows to 412 in the second half. I mean, that's sort of a small increase on cost of sale in relation to the small increase of the relative sales. So I think that's, given that there's been price rises, given that Greggs have basically push through price rises to offset inflation cost rises. The margin, the relative margin should be preserved or close to being preserved. So I don't think that's going to turn out to be far wrong. I've taken a pro rata approach on the overheads, and that gets you to 196 million operating profit in the second half, which obviously is a vastly higher number than the first half operating profit, which was just 70 million. And that would take you to 265, which is about 20% higher than what it was last year. Now, if that's the outcome, I'm not saying it's definitely going to be that, but if it's close to that, certainly if it's above 209, if what we're then saying is 2026, if there's no consumer recovery, they're going to make at least, let's say 210 million. Let's say I'm out by 20%. That's pretty good. I mean, that's not a terrible result. And for a share that's valued at 1.6, it's pretty cheap. Obviously, that's the operating profit, not the net profit. Net profit's harder to determine because there's a lot of other parts going on. But again, this 47 million net result is pretty. There was quite a few reasons why that was sort of as a one-off poor result in that particular period of time. The run rate going back, I mean, you're looking at 120 to 150 million. So again, if we see something, I mean, out of this, I mean, when you sort of think 196 million, 196 million operating profit. I mean, what sits below an operating profit? Well, it's tax. It's going to be, I think that's going to be sort of the chief. Any sort of foreign exchange. Well, there's not really any foreign exchange because it's pretty much all UK. So that net profit will probably be, I mean, it's got to be close to, if not above 150 million. And again, if that's the case, 150 million and you're paying 1.6 billion for that company, I mean, just let's go in and stick it up on share scope. So I'm saying 1.6 billion, 1.666 to be precise. Um, that's not bad. I mean, that's a price earnings of 11 times, where the cash generation, so free cash flow, this investment number, we know that investment number is likely to be 300 million. I haven't filled this out, but 300 million in 2025. So dropping to probably below 200 million in 2026, and then perhaps to just maybe 100 million in 2027. So there's at least an extra 100 in the business next year if they're getting the same result, and if we're talking about something like a 350 million cash generation from operations, probably with some working capital getting sucked up into it. There's a lot of scope there for buybacks, for dividend. Well, certainly for the existing dividend, easily. Uh, Potentially for higher dividends. Share buybacks if they announce a share. I mean, they've done share buybacks in the recent past. They're not afraid to reward shareholders. In fact, they'll say, here's the 5 things we do with our capital allocation, and it's basically put enough money to maintain the business, which is about 10% of revenue. Um, Keep enough working capital, so we're not short of working capital. Look at doing any investments where the return on capital is at least, I think they said 25%, but I couldn't find that reference today. So I'm going to say 20%, which is their historical return on capital employed. So that that's something else. So yeah, look, I think we could be pleasantly surprised with the 2025 outturn, and then the whole, is it going to be as good or is it only going to be as good in 2026? Well, why is that a problem? Because, at 11 times price earnings, where they are still growing. I mean, you look, they've opened 120 shops. They've gone from um, 2,473 to 2,600 to 2,000, well, sort of not far off 2,800 by the end of 2025. I mean, that's what, nearly 400 shops? Sorry, no, it's not. It's 300 shops in 2 years. So 150 shops a year over the past 2 years. They reckon they're going to do 120 next year. That's going to get them not far off 3,000 shops. And it's back what, 7 years ago, 8 years ago, they were at 2,000 shops. So they've grown their empire by 50% in terms of number of shops, plus all the business to business. They're now in Tesco's. Tesco's is much larger than Iceland, massively larger, in fact. So I also think that the bit that the market's missing out and ignoring is the small print. That they achieved 13 million of efficiencies. It's all there. It's all there in the announcement. If we go and look it up, there it is. Oh, it's not there. It's not there. It's there. Cost reductions delivered a further 13 million in efficiencies. They're manually picking all the stock at the moment. They say in for distribution centres, they want to automate all of that. Now, when you're dealing with sort of thousands and thousands of shops, and each of those thousands of shops, I mean, I've not sat there and counted, but I mean, we're talking hundreds and hundreds of pasties per shop per day. I would venture to say. I mean, they got trays and trays and trays of them in a trolley. Um, I'd say there's, yeah, certainly a few hundred per shop per day. Maybe there's slower days, like some shops that are open Monday to Friday and things like that. I mean, I just don't, I don't spend my life sort of frequenting Greggs, getting to know Greggs as intimately as I can. But though with those sorts of metrics, automation of that is going to be massive, and being able to use AI to calculate and work out, because you think what costs the business a lot of money. I mean, people go on and on about theft costing them a lot of money. It probably does to some extent. um, I mean, theft is illegal, and shoplifters get reported to the police, and the police are there to arrest shoplifters. So I kind of don't get these commentators that say, "Oh, yes, there's just like a daily theft from my local Greggs." Is there though? Is that really the world we live in, where just some individuals are just going into shops blindly robbing them every day in, day out, and the police are standing by idle doing nothing? I find that a bit hard to believe. Maybe that is the truth. Maybe that is the facts, but it's not the world I live in. I went into a supermarket today, with a member of my family. Um, that person said, "Oh, I need a shopping trolley." So we waited for a person to come through the turnstile things, the gate things. We walked through those gates the wrong way. They obviously open one way. The alarms went off. Security guard was there in an instant. He said, "Oh, everything okay?" And see my mother, see, like, "Oh yes, just getting a trolley." like I don't think this idea of just people are thieving millions and billions from Greggs is reality. I think there might be an element of that, but it's not as prevalent as. But no, sorry, yeah. Going back to the central point, I think the thing that costs Greggs and any food company a lot of money is waste. The unsold food, because they sell it fresh. If they don't sell it, if they get 200 pasties and they don't sell 200 pasties, they sell 190. 10 of them go in the bin, and what going in the bin means is that they go for methane production and biofuel production, and they get recycled in that sense, or they get sent to a kind of one of their surplus shops where they get sold for half price or a 90% off or something like that. So essentially there is sort of a way of dealing with waste. But if you can use algorithms to work out that, because the temperature tomorrow is going to be 12 Celsius, and on a 12 Celsius day that you don't sell 200 pasties, you only sell 190, and I don't know, such and such is happening. There's the football games on this Saturday, and it's to Saturday today, and so you always sell X% more. These algorithms will do all of these things, and so there's not sort of like human beings kind of like, oh yes, I've got to, or I've got to get sort of 30 more pasties for such and such Greg's shop. Like things are not that. Yeah, automation can make all of that happen in a way that human beings just can't, because it's just too complicated. So I could see, when I've sort of said in my article that this can, and as far as I'm concerned will deliver a 20% return on investment. I mean, I think that's easily achievable from what I've seen of how automation can just improve the productivity, reduce the waste, improve the handling costs, is just absolutely transformative, using MRP to calculate what's needed when, just in time delivery. Just having things happen that way is absolutely transformative. So um the fact that they're putting all of that in, and that's all to come, I mean, that's a massive reason to be, I think, people who are sort of saying, "Oh, well, Greggs has run out of, what was it? Run out of mojo." Like, do you, yeah, like you're not seeing what's going on around you, the automation they're putting in. These guys have invested. I think it's in, where is it? Maybe in here, where when you actually look at the level of investment that they've put in, it's colossal. There we go. Oh no, it's not that. It's let's have a look. I think I've got it here somewhere. Says he that yeah, the amount of investment that they've put in, I think it's here. There we go. Capex over the years. I mean, nearly £1 billion. Now, obviously, some of that will just be sustaining capex to keep stuff going. The coffee machine breaks, you need to get a new one. Coffee machine only lasts 5 years, so 363 of it is just say it's in the bin. It's keeping the stuff going, but you're still talking like over £500 million of investment, and the reason they will have invested that money, um, up to the end of 2025, is to make a 20% return on capital employed. Because if they weren't making that, their return on capital employed, which at the moment is 20.3, would go down. It's as simple as that. So I think the point about automation is just being overlooked by certain people. Um, and we see, the benefits of efficiencies and automation here in the trading update. That's an excerpt from that. We can also see that yeah, we can also see that on the day that they released the results, that yes, it dropped down, but we also see that there was a pushback. So it ended 6.5 down, and I think today is like maybe another 1% down. um, I think the things I'd call out, I mean, number one, they are taking market share. They're taking market share in the evening, which is not where they're strong, not what they're renowned for. They're first place for breakfast and probably sort of up there top whatever for lunches, but taking share from competitors in the evening is what was music to my ears, because that, as far as I'm concerned, is like a second business. So the fact that they're succeeding in doing that, great, fantastic to hear. That I think again is just being overlooked by the market. Um, Somebody said, "Oh, the cash is down year on year." Well, yeah, they've been spending a lot of money, but cash is up since the last time they reported cash. In other words, in the second half of the year, they've generated more cash than they've invested. So net cash is actually up. And because that's net cash is up, net of working capital, which will be increasing because they're increasing their number of shops. I mean, I don't know that for certain, but it's likely, it's probable, um, that again, that's a further positive. Now they do talk about a 4.5 million exceptional cost, which is the first exceptional cost in 3 years, and and they also talk about underlying. Now, I picked up on this, and I like picking up on certain words in RNSs and pondering them because I think, why have you said that word? And I think that's important because if you had a business that had been throwing in all sorts of exceptional costs year after year after year after year, and we're arguing, oh, but our underlying numbers are completely different, which some businesses do. I mean, there are businesses I've looked at that, oh yeah, there we go, another result, another adjustment. And I've sort of said, it depends what the adjustments are for. You've got to kind of get into the detail, like with Begbie Trainer, for example, lots of adjustments there. And anyway, that's another story entirely. But Greggs have not ever, or not, sorry, not ever, not for the last 3 years, posted any exceptional costs. So why did they use the word underlying? Now, I think that's because, I mean, they do disclose there's 4.5 million of exceptional costs, but I actually think there'll be more. I think what we're going to see is that they're going to say, you know, here's some one-off costs that we're throwing at the market, and this is why our profit is down, and going to be down in 2026 because X, Y, and Z has happened. And I don't know what X, Y, and Z is specifically, but that's what that underlying that word underlying is sort of signaling, I think. Um, but behind that, they'll then be saying, well, but yeah, look at the underlying numbers. Look at once that temporary, because that's the thing about the word underline is it's also the word temporary costs, because that was the other thing that I was sort of flagging here with tempo. There'll be some temporary pressures on margins. Another clue that there's going to be exceptional costs in 2026. There's something brewing, something they're going to do, that there's going to be a one-off cost and profits will be only as good as 2025. But look at the underlying numbers. The underlying numbers are actually improving. They're actually stronger. They're actually better. That's kind of, to me, that feels like what's going on or going to be going on. We don't know that for a fact yet. It's just my supposition. But look, I mean, we know that investment was due to be about 300 in 2025. We know that the first half it was a 170. That means that the second half probably is about 130. We know that cash has grown by 15. So we know that exceptional costs are about 5. So that gets you to 150 million cash from operations. But then you've got to think, well, yeah, but working capital is sucking up cash as well. So if working capital is somewhere 30 to 50 million, which is what it's historically been, you're then looking at about 200 million in the second half of cash generation, which, going back to that big grid of numbers that I was showing you up here, yeah, I mean, if they're generating 350 or more cash from operations, then that is a very strong result, and that's spot on to my own estimates, or actually stronger than my own estimates, if I'm right on that. Um, it's also the case that with lower investment levels, it won't be 300 million, as I said, it'll be 200 million. That means there's another 100 million of cash available for buybacks, for paying down debt. Not that they have great amounts of debt, but yeah, higher dividends. There's or acceleration of the store expansion program. Anyway, number C was that they said they anticipate a inline outcome. So what do they mean by an inline outcome? Well, they said that they said that their first half operating was going to be lower than 1H24, and it was 70, and net profit was 47, reflecting the stronger comparative trading performance of 2024. But now, these are important words, I think. For the full year, our cost inflation outlook remains unchanged, and planned cost mitigation measures are expected to enhance second half performance. So they're telling us that, yeah, the first half wasn't great, but the second half's going to be a lot better. And then here they're saying it's in line. So they're telling us that the performance in the second half of 2025 is stronger, better. Yeah. So again, like I think it's just completely been missed as far as I can see, based upon what I've read of people's comments and listened to sort of commentators on videos or whatever. I just, yeah, absolutely think they haven't picked up on a lot of these things. Here we can see that operating, this is the weaker first half that we're talking about. I mean, it wasn't that bad. It was down 5 million, which is about 7% operating profit. Pre-tax was a little bit more, but then some of that was kind of one-off factors that affected it. So and of course, the employer's NI is going to have an impact. So, but you've then got price rises that offset those cost increases. So, looking at price rises, I mean, price rises are actually quite substantial. And somebody sort of said that as a negative. Oh, well, Greggs aren't that cheap anymore. Well, where is? Like, I'm sorry, but where is? I mean, you go to, you know, other fast food, or if you go to fast food places, you don't get much from £10. It's a lot more expensive than even just a few years ago. So don't tell me that £1.35 is breaking the bank, because I'll just laugh at you. A £4 breakfast is actually pretty good. I mean, that I think is 20 pence, is 20 pence breaking the bank? Yeah, I think you need to have a word with yourself, because I think if you go into supermarkets and different places, and the quality is not great in the supermarkets. It's not the meal deal is, I think, quite passe, and but everyone's different. So I think having a hot meal versus a meal deal, I mean, it's just completely different proposition. It's the sort of meal deal from the supermarket is yeah, it's not the same thing. Um, okay. I guess the other thing I'd point out is that whilst yes, there was cost inflation in 2025 and 2024 and 2023, look at what is actually happening out there to commodities, to soft commodities. Wheat down, butter down, potatoes down, massively down. I mean, like nearly 80% down year on year. Cheese 26% down, milk 26%, and so on and so on and so on. Incredibly, actually, I saw that eggs in America, I mean, there's nothing to do with Greggs, but eggs in America are down 93%. I mean, it's just bonkers how much soft commodities have reduced by. Most soft commodities have reduced by. Um, and yes, this isn't going to necessarily mean that Greggs all of a sudden is going to buy things 30, 20, 30, 40% cheaper, or 80% cheaper if it's potatoes. obviously they don't sell many potatoes in Greggs, but you get the idea that those, inflationary price rises, well, they are in the rearview mirror, and if anything, we're seeing reducing prices, perhaps even some reductions in prices. So maybe again, there's some room for optimism in all of that. Whereas I think we're fixated in this cost of living crisis that just seems to be relentlessly, oh, it's only ever going to go up. Well, no, it won't only ever go up. It'll go up because of inflation, and if there's rising prices in the commodity that you're trying to buy, well, commodities go up and down. I'm sorry, that's just the facts, and they've gone down over the past year. Is what that's showing me there. That's coming from trading economics. It's also the case that they've managed to grow their estate. Now, these are calculations. These are based upon those estimates that I walked you through earlier a moment ago about cash generation. But if I'm right on those numbers, well, what I'm also then showing you, I mean, these are just the other numbers here are just facts. These are the number of shops at these different points in time. So we're seeing that sales per shop are growing. So the central one of the well, I think one of the thesis of people that are short in this is saying, oh well, Greggs have reached saturation. They've lost their mojo. There's too many Greggs. There's no excitement left. Well, if there's no excitement left, how are they how are they maintaining a steady amount of cash from each shop and growing the sales at each shop? How is that possible if there's saturation? The only explanation is there isn't saturation. And I've done this quite a number of ways now, because there was also in this article somebody saying, "Oh well, it's all saturated," and yeah, we in actual fact, when you look at it, same sort of calculation here, but this was sort of taking somebody's approach to say, let's take the contribution per shop, um, and then take the maintenance capex to then work out the operating cash flow per shop. And again, it's sort of it's not the case that we're seeing something dropping off a cliff, that the revenue per shop is growing. Operating cash flow is massively above what it was back in the 2010s. And it's okay, yes, you can see there it's down a little bit from 2023, 10% down maybe, but the share price is down far more than 10%. So don't tell me that that is the reason for this to be shortable, because I don't buy it. And once again, you would expect these numbers to be dropping off a cliff if there was saturation, and it's that number that matters, because this one is much more about previous cost inflation, whereas this one is about saturation. This is about the revenue per shop. I think this was interesting as well. Again, we don't have the precise numbers yet. We'll get those in March. But if you go back historically, I mean, you can see over the past 3 years. So what I've done is I've just taken out the first half numbers and the second half numbers, because Greggs, there's quite a bit of seasonality to Greggs. If you do this, you can sort of see operating cash flow grow, grow, grow. One H23 to one H25. Now, because the amount of capex has grown, because they've been doing all of that automation that we talked about, the grey, which is the free cash flow, has been dropping. That's true. But operating cash flow is actually increasing and rising. Second half, it's sort of a bit less clear to see. I mean, you maybe can agree with me on that there's a mild increase in the second half results. But will we see a bit of a spike and a change, something more along a line that runs through this 2023 result, where this one's a bit of an aberration, let's say, and then because again, this is kind of when inflation was very high. There's obviously Labour had just come to power. There was all, I mean, as much as there was this big hoo-ha this past year, or sorry, last year now, in the 2025 budget. There was a big hoo-ha in the 2024 budget as well. I mean, maybe we forget this, but we had this massive build up to this November's budget, or to last November's budget, but there was equally as much of a build up the 12 months prior. And maybe those 2024 results were a reflection of that. But anyway, so that's point number four. Successfully growing its estate, and um, yeah, I mean, I guess the fifth point I would make is around just the 7.4% higher sales in 4Q25 versus 4Q24, whereas company managed shops like for like were 2.9% higher. Now, yeah, some of this is going to be down to franchise shops. Some of it will be down to new shops. But new shops, I mean, if they've opened on the 1st of December, they're making virtually no impact. If they've opened on the 1st of July, okay, those shops are brand new and they're not necessarily going to be as busy on day one and month one and even year one. It takes time for consumers to go, oh, there's a Greggs in the so and so shopping centre now. These things build up over time. So no, for me, I think it's very clear that the difference is down to the relationship with Tesco's. That for me feels like the explanation. We won't know that for sure until we get the full year results. But if I'm right in it being something like a 20 million revenue bump, that compounded and obviously continuing to grow, because we know that they've only reached about 30% of the UK Tesco stores, and that's Tesco's, not the shops that Tesco own, like I think Premier and Jack's, and these other brands that ultimately are just Tesco stores by without the Tesco sign on the outside of them, selling Tesco products. That yeah, I think that is just the beginning, and when you actually look that the number of millions of shoppers per day in Iceland is less than a million, and at Tesco's it's 17 million. I mean, that gives you a sort of an idea. It's 23 times larger. So, they are already selling an estimated, and this is just my estimates, I've not been able to find any precise, but I've sort of said 200 units at each supermarket, 1,000 supermarkets, 52 weeks is 10.4 million packs of pasties or whatever at £1.60, where Greggs gets £1.10. I mean, if all of those estimates and assumptions are correct, the Tesco deal, I mean, yes, 20 million in quarter four 2025, but has the potential to grow the business by about 10%, or well, I've said 12.9%, but on today's, 2.15 billion, that 260 billion, well, I suppose it is still about 12%, to be fair. Underlying, and I've talked about this already, so probably I don't need to say much more about that, but I do sort of think that they're signaling for us to be able, or being expected to kind of say, oh, there's the headline profits and then there's the underlying performance of profit. So I think you've just got to sort of take that and look at what that is. It's interesting. I think this is something I added in later to the article, but when you actually sort of ask yourself the question, is the UK consumer tapped out? Is it the case that the negativity that comes across so prevalently in the trading update from Greggs? And to be fair, they're saying it as they see it, fair enough. But let's look at what the actual evidence is across the UK. Well, consumer confidence is pretty negative, but it's been pretty negative for years. Like, tell me when it was positive. Well, it's never been positive. Net. This is net positive, by the way. Never been net. Well, actually, sorry, yeah. 10 years ago, it was net positive just for a short time, just a very small amount. There's a tiny little bit of blue just peeking away there 10 years ago. But ever since, we've been negative. Like, it's just been, but it's not as bad as like 2 3 years ago, 4 years ago. Like, this was far worse. So, and this was when Greg's share price was far higher than today. So yeah, does it deserve to be substantially cheaper, where negative when consumer sentiment is actually less negative than recent times? But that's the worst statistic. If you actually look at retail sales growth, well, again, it goes up, it goes down. I would say overall it's pretty flat at the moment, but it's not net negative. I mean, look, it's not COVID like there. It's not even what would that be? Liz Truss by there, and whatever that was by there. I think that was when the stock markets went whoosh, and that was just before Christmas, and maybe we had sort of negative Christmas, something like that. Uh, Wages are growing by, just about 5%, 4.5 to 5% consistently. So when wages are growing at 5% a year on average, are you telling me that people are sort of, "Oh, I can't go to Greggs because, I don't like it just doesn't add up for me that that is, when wages are showing that, that's a very positive wages statistic as far as I'm concerned. If you actually strip out inflation, it's net positive. Now, obviously, it's not net positive in any great big positive way. You can sort of see it's dropped in 2025. So net wages, and that's because wages themselves have been, as you can sort of see here, wage rises were far higher under high inflation and are far lower under lower inflation. Well, hey, that's normal, but we can see it's still positive. We can see savings. Now, again, when panic sets in, you'd expect savings rates to go shooting up in the air, just like during COVID. Yeah. Uh, are they shooting up? No, they're declining. So when people are spending money and not saving, they're reducing their savings. That tells you that there's a overall positive. So there's a lot of signals, there's a lot of statistics, current statistics that say to me that things aren't quite as bad as Greggs themselves seem to think they are. There's then other things I mean, yes, we've had all the taxes and the negativity around the taxes, but those taxes are also being pumped back into the economy through minimum wage increases. In other words, some of this, in fact, quite a bit of this net wages is going to be minimum wage. I mean, in fact, if you took minimum wage out of those numbers for the middle class and for non-minimum wage people, probably it is net negative, I think, because minimum wage is going up by 8%, and um, I think statistically, the number of minimum wage people that shop at Greggs is proportionately quite high. I think that's just my impression. I might be wrong on that. It might be that Lord so and so and Viscount so and so are really the core shopping demographic of Greggs, but I don't think that's the case. I think that it's more of a working class shop. You might take umbrage at that comment, but I think that's the truth of it. And minimum, the minimum wage increase, the two cap, the two child benefit cap, which is worth thousands and thousands and thousands and thousands to somebody that is working class and potentially low income. Um, and of course, rich people can have more than two children as well. I'm not saying it's sort of, but you get the idea that there is sort of I think a beneficiary to these tax changes, in my opinion, is Greggs. And obviously none of that is in the trading update. None of that is in the commentary of whoever. You can go on Twitter and read about various people sort of saying different. Oh, there's me. There's my article. But like this, for example, they're quoting the tough trading backdrop. They're quoting um, the comparative performance this year versus it's not going to be better than this year. We don't even know what this year's performance is, but it's not going to be better next year in 2026 in the current year. I keep saying next year, it's not next year, it's this year. But you get the idea that um, I think there's a lot more positivity than is being made out. And I'd also just reiterate the point around technology that they've said that the fit outs of the distribution center, of the manufacturing center, the automated picking, that's all on track. That's all, that's all going to be going ahead. That's going to start in 2026. I've said about the 20%. That's the 20.3% there, taken from the 2024 annual report. Yes, some of it will not kick in until 2027. That's true. But I keep going back to sort of, people. I've had some people sort of commenting and say, oh, well, it's not going to happen till 2027. Yeah, but shares reprice ahead of the things happening. I mean, sorry, if you don't know that, then, hey, that's the world we live in. That once it's apparent that something is on a trajectory, then, the share will re-rate towards that trajectory, or based upon the anticipation of it happening. But I just don't think anybody's anticipating it. It's like, oh no, no, they've just thrown 550 million at something, and who cares what it is? Like, well, if they're throwing it at something that's going to deliver a 20% or better return, that's 100 million of profit that you're not considering. Like, hello, 100 million in addition to all the existing profit. So again, I just think that's something that's not being properly understood. So anyway, look, just to conclude, I've probably said enough. 50 minutes. But yeah, look, if it's only an outturn, operating profit outturn of 265 million, it's cheap at that sort of profit level. It's not bad. I mean, for it to be only 16 quid a share, to be delivering that level of that many millions of profit, I can live with that in 2026, because I know in 2027 it's going to be higher. And I think that it's not defined, and it's not burned in. It's just they're saying, if the consumer backdrop remains just as dreadful as we are finding it, then we're only going to do as well as we've done in 2025, is what they're actually saying, because of temporary factors. It's all there. And I mean, it's there, the word temporary pressure on margins, it's all there. So there's lots and lots of reasons why I think that certainly the shorters, I think, are on very thin ice. I really do think that. But look, ultimately, none of this is advice. It's just my own personal opinion, and me setting out why I think what I. And why I've written what I've written. This is my Substack, theoakbroke.substack.com. This is the commentary, so you can sort of read other people's thoughts on it, and ultimately just form your own opinion on this. And uh, you know, investment comes with risk. It's about taking calculated risks and looking at the numbers and trying to assess and analyze, and looking at the words and trying to assess and analyze. I draw out that word underlying, I draw out that word temporary pressure on margins. Have a think about those, and yeah, I hope that's been useful. If you like what you've listened to, do like the video and subscribe. Really appreciate your watching this, and that's enough from the Oak Bloke. Cheerio for now. Cheerio.